the trajectory of deficits are actually going to accelerate under Trump compared to where they were under Biden. And they already were accelerating. Foreign central banks are buying fewer treasuries, but also a weaker dollar. And that's going to raise the cost of goods, of imports in particular for Americans, because you're not going to have foreign central banks propping up the dollar. And it also means much higher gold prices because that's what they're buying. So lower treasury prices and higher interest rates and higher gold prices. But at the same time, you're seeing a shift among private investors out of U.S. financial markets.
In recent years, central banks have been quietly but steadily accumulating the metal. Global official reserves now exceed 35,000 metric tons, and the buying continues regardless of price swings. This isn't speculation, it's a fundamental rethinking of gold's role in reserve diversification. Financial commentator Peter Schiff argues that the world is making a silent but profound shift. Foreign central banks are rapidly selling dollars and buying gold at a record pace, while private investors are shifting their capital from U.S. stocks to foreign markets. Schiff believes this trend is structural, not temporary. In his outlook, foreign markets offer better valuations, stronger dividend yields, and more reliable returns than the S&P 500, which he expects to underperform for the rest of the decade. Schiff takes it a step further. When measured against gold, the S&P 500 is already in a state of collapse. He blames U.S. policies under Trump's administration, a weak dollar stance marked by low interest rates, money printing, and tariffs that he says hurt consumers and push capital offshore. Meanwhile, U.S. debt has surged past $37 trillion, compounding the problem. The result is eroding trust in the dollar and renewed demand for hard assets. Gold has already been climbing as investors seek safety, and Schiff sees that momentum accelerating. In his view, the U.S. isn't just facing a market correction, it's watching the foundations of dollar dominance slowly unravel. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
But I think the bigger picture that investors need to be aware of is that there is a massive shift going on around the world, and it's really two-pronged. From the point of the central banks, it's a movement away from U.S. dollars and into gold. So central banks that had heavily relied on the U.S. dollar as a primary reserve asset, they are divesting of dollars, and instead they are accumulating gold. And so that is, a big change. It also eliminates a big buyer for our treasuries. So the result of that is going to be higher interest rates for Americans as foreigners, foreign central banks are buying fewer treasuries, but also a weaker dollar. And that's going to raise the cost of goods, of imports in particular for Americans, because you're not going to have foreign central banks propping up the dollar. And it also means much higher gold prices because that's what they're buying. So lower treasury prices and higher interest rates and higher gold prices. But at the same time, you're seeing a shift among private investors out of U.S. financial markets, so out of U.S. bonds and stocks, into their own market. And so that's why you're seeing this huge, outperformance. I mean, for example, I think the S&P is maybe up about 9% year to date, but the Euro-Pacific International Dividend Payers Fund, which is just a fund of foreign stocks, is up 36% on the year. And that's a reflection of money going back into foreign markets. And, foreign markets have much lower valuations than U.S. markets. So you get a lot more for your money. You can buy stocks a lot cheaper. The dividend yields are a lot higher, and you don't have the weakening dollar. And so this is a major shift because for the 10, 12 years before that, the U.S. stock market was the strongest, the dollar was strong, and money from all over the world was coming into our markets. Now that money is being sucked out, and it's just beginning. So I think this is going to be a long wave that's going to continue for the rest of this decade and into the next, where the U.S. stock market dramatically underperforms the foreign markets, the mirror of what had been happening over the prior decade. So I think it's important that investors recognize this and move as much money as they can into international markets and also into other things that do well with a weak dollar: gold, silver, commodities. Uh, those are in bull markets when the dollar is in a bear market. And I think that's where we are. Central banks moving out of dollars. The United States is in a very precarious financial position. For years and years, they've been talking about this unsustainable fiscal path. Well, the reality is, we passed that unsustainability a long time ago on this path. I mean, we've arrived at an unsustainable situation. And I think our creditors recognize our inability to service this, massive debt. It's over 37 trillion now. And the Trump administration has thrown gasoline on the fire, with the big, beautiful bill. The trajectory of deficits are actually going to accelerate under Trump compared to where they were under Biden. And they already were accelerating. So the debts are really exploding out of control. The tariff revenue, which again is just a tax on American consumers and American businesses, the tariff revenue is not going to be big enough to offset what the government is losing from the big, beautiful bill. So the deficits are going to get worse, even despite the mitigation from the tariffs. But meanwhile, the tariffs are harming American industry. They are making American industry a lot less competitive. And they are causing a lot of our trading partners to look for ways, to avoid the U.S. And trade more with themselves. So it's more of an isolationist approach that's going to harm the U.S. economy. So it's we're making the situation worse for ourselves. So that's also one of the reasons that capital is leaving the U.S. because tariffs are making America less competitive. So why do you want to invest in U.S. companies that have to deal with all these tariffs when you can invest in foreign companies that don't? So we've really shot ourselves, maybe not even in the foot, like in the stomach or maybe the head. But the country's in a lot of trouble, and our creditors know that, so they don't want to loan us more money. And they know that the dollar's going to fall. We're going to inflate away these liabilities. Yeah, look. Regardless of what happens nominally, real U.S. stock prices are going way down. I mean, if you're going to measure U.S. stocks in gold, and U.S. stock prices have been falling for 25 years measured in gold, right? But I think that the pace of that is going to accelerate. I think you're going to see a much bigger drop relative to gold. But we may even see a drop just nominally because the U.S. market is so overpriced. It could even decline nominally, especially like tech stocks, the NASDAQ. I mean, some of the stocks that are really up there could fall even in nominal terms, but they'll get killed in real terms. So that investors should be getting out. As I said earlier, it's pretty clear that the superior returns are going to be earned outside the United States for many, many years to come. The dollar is going to be marked down. The only question is how much. I mean, we actually have a weak dollar policy, even though, they don't want to come out and admit it. If you read between the lines, and it's not that hard to do, that's what everybody in the Trump administration is advocating for, is a weaker dollar, a lower dollar, which, with the tariffs actually makes it worse because not only do we have to pay the tariffs, we have to pay more dollars to buy the stuff that's tariffed because the dollar's lost value. So it's not that not only are foreigners not paying the tariffs, we're paying double because of the weakness in the currency. But that's what Trump wants. Trump wants lower interest rates. He wants the Fed to cut interest rates and print money. That means a weaker dollar. That means higher inflation. That's the whole policy. Let's run more inflation. Let's try to ramp growth by creating inflation, which jack up stock prices. Let's push up real estate prices by trashing the currency.
Peter Schiff is warning that a Fed rate cut could backfire in ways markets aren't fully pricing in. If the central bank cuts again, he argues, long-term yields are likely to rise rather than fall. The message would be clear. The Fed is prepared to let inflation run hotter, making U.S. debt a dangerous bet for investors. Schiff believes that if the 10-year yield climbs to 5%, the Fed would have no choice but to step in with yield curve control, essentially capping yields by printing more money to buy bonds. But that kind of intervention, he cautions, would light the fuse for hyperinflation. This comes as investors eagerly await signals from Fed Chair Jerome Powell, who speaks Friday at the annual Jackson Hole Symposium. Hopes are running high for a September cut, but the $28 trillion Treasury market is flashing warning signs. The yield curve has been steepening, suggesting that bond traders see inflation pressure building even as growth slows. At the same time, Schiff takes issue with how inflation is measured. In his view, the official CPI figures dramatically understate the erosion of purchasing power. Businesses are still working through old inventory, which has delayed the full pass-through of higher costs. However, with tariffs and supply chain pressures still lingering, he says it's only a matter of time before consumers feel the real impact. Let's get back to the interview.
Before the last rate cut a year ago, I was forecasting that if the Fed cut rates, that long-term interest rates would go up. That was what I was predicting, and that's exactly what happened. And I think the same thing will happen again. I think if the Fed does cut rates in September, the yields on the longer bonds will head in the opposite direction. And that's because the Fed is too easy. In fact, if you look at the inflation numbers that we have now, they argue for higher interest rates. Interest rates are too low right now. In fact, I've been saying the whole time that the Fed prematurely stopped hiking, that it hiked too soon. I mean, it stopped hiking too soon and it cut prematurely. And so inflation is accelerating and the problem is getting worse. And instead of hiking rates, the Fed is discussing when to cut them. And so if they actually do cut them, that's a signal that inflation is going to be allowed to run out of control. And that is going to damage the longer end of the bond market. That makes longer term U.S. obligations even less appealing because inflation will erode away more of their value. So the Fed's going to lower short-term rates, but the market will increase long-term rates. And that will include mortgage rates, because I think what's going to happen is that the upward pressure on rates is going to become a big problem for the economy, politically, especially when you see the yield on the 10-year moving north of 5. I mean, it's, only really gotten as high as 4.5, and you have the 30-year at 5. But when you get the 10-year, I think at 5 or maybe north of 5, and then you get the 30-year pushing 6, I think that's going to be very problematic. And I think there's going to be a lot of pressure on the Fed to do something about that. And so the only thing the Fed can do about that is, of course, to officially go back to a, wide scale QE program where the Fed just buys up all those bonds to force the price up and the yield down. But of course, that throws gasoline on the inflation fire. And that may be a very short-term fix, but it will blow back, at the Fed violently in the other direction. So even if they can orchestrate a short-term decline in long-term yields, they're going to blow out because the market is going to push them unless the Fed, really just pulls out all stops and does the, whatever it takes. We will print an unlimited amount of money to make sure that yields don't rise above this level. And then they open up, a trap door underneath the dollar, and then you just get a free fall and, massive inflation. And then the problem there is, yes, there's yield curve control for treasuries, but what about everything else, right? While the Fed is printing up money to buy treasuries, what happens to corporate bonds? What happens to muni bonds, right? What happens to whatever the Fed isn't buying? Those things are going to get killed. And so maybe the government gets low interest rates, but everybody else gets much, much higher interest. Well, I mean, first of all, the CPI is a very, biased or manipulated measure to begin with, where, it's not that there's somebody behind the scenes fudging the numbers, but the methodology that defines how the CPI works is very flawed. And what happens is price increases don't actually get reflected to the degree that they've increased in the CPI. Like I did a exercise years ago in 2013. So this is a while back, but I remember back then I read that according to the CPI, newspaper and magazine prices were up 30% over 10 years. And I kind of found that hard to believe. I thought it was up more. So I checked. I went back to 2003 and I looked at about 20 popular newspapers and magazines, and I looked at the price on the cover. and I compared it to the price on the cover of those exact same newspapers and magazines at the time. So there's a 10-year gap. And what I found just looking at the prices had gone up by 130%. Yet the CPI said 30%. Now, I don't know how that happened, right? Somehow they put in 130% increase, but the CPI just spits out a 30% increase. Where did that other 100% go? I don't know, right? That's the magic of the CPI. It makes inflation disappear. So one of the reasons that the CPI is not showing price increases that result from tariffs is because it's not accurate. But now another reason is because of a lag. Look, I am a business. My costs go up. I don't necessarily immediately raise my prices. I mean, first of all, I have a lot of inventory that I might have bought before the tariffs. And so I'm not necessarily pressured to raise the prices there. I don't know if the tariffs are permanent. Are they going to go away? I mean, do I really want to raise my prices and then cut them back? I mean, let me see what happens here, because you might be reluctant to jack up prices. Maybe your competitor doesn't do it. You're worried I might lose some business. So there is a little lag as businesses try to figure out, are these price increases permanent? Are they temporary? The different things. But ultimately, the decisions are going to get made. The prices are going to be increased. Businesses will act the same way if their labor costs go up or their rent goes up or their material costs go up. They don't necessarily immediately raise their prices. It may happen months later, by the time they take a look at everything. So there's going to be a lag. So you can't just say, aha, you see, they're not, prices aren't going up, because they're going to go up. Where is this tariff revenue coming from? Obviously, U.S. businesses are paying it. Foreigners aren't paying it. Foreign governments, foreign companies, they're not slashing prices. Because if this were true, you would look at the import prices and you would see prices crashing, because the only way foreigners could be paying our tariffs, and if our average tariff rate now is 15-20%, the only way foreigners would pay that, they would have to say, okay, America, we know you're going to get hit with this 15 or 20% tariff, so we're going to cut our prices. We're going to let American companies buy our stuff for 15 or 20% less, so that when you pay your tariffs, it's the same. But they're not doing that. Prices of imports aren't crashing. And we're paying the same as we were paying before. So American companies are paying these taxes. It's only a question of time until the customers pick up the tab, right? Who else is going to pay for it?
The gold market continues to trade below initial resistance at $3,350 an ounce as the Federal Reserve attempts to extend the clock, stating it needs more time to assess the health of the U.S. labor market and the trajectory of inflation, according to the minutes from the July monetary policy meeting. Although 2 Federal Reserve Committee members voted to lower interest rates during the July meeting, the minutes show broad support for the central bank's neutral monetary policy stance, as the threat of inflation looms larger than slowing momentum in the U.S. labor market. Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.